Today, we're going to start the session with a conversation with Vinit Bhansali, founder and GP, Takshil Venture Partners. Welcome, Vinit. Thank you for coming to the show today. Looking forward to getting to know you. Your line is...
Thanks, Ramana.
Perfect. How are you? So, Vinit, let's start with a bit of introductory, material. A bit of background from you, personal background, as well as Takshil Venture Partners to get us going.
Sure, Samana. Thank you for having me over. And I'm absolutely amazed at the community that you have built at 1Mby1M. A little bit of a quick background, like a lot of young founders that you are here to support. I used to be one of those young founders. I started my first startup when I was in my third year of, my undergrad degree. And it was a software company. I got a little lucky. In 2007, one of our competitors acquired us. This was in New Jersey. And then after that, I started two more startups. Mm-hmm. The second and third ones were in India. The third one also got acquired. I never raised, it's kind of funny that I am here as a venture capitalist, but I actually never raised money from VCs. I had to use my own effort and make my companies profitable if I wanted to make any money.
It's good. Very good. Our philosophy in 1Mby1M is entrepreneurship equals customers, revenues, and profits. Financing is optional. Exit is optional. You do need an exit if you raise financing because most investors don't really buy into the dividend concept. And it takes a long time to get to a place where you can offer dividends to your investors. So exit is kind of the operating principle of venture funded startups in our industry. So Vinit, now that you have decided to start investing, what is your investment thesis? What is the premise of the Takshil Venture Partners Fund?
Great question. I think we are page. We believe there are incredible entrepreneurial opportunities all across India. There is a massive opportunity to start discovering young founders who are able to build out products and companies on very unique, very vertical use cases. And within that, there are certain sectors that we believe are underserved in India and that will see massive growth. And that is what Takshil stands for. We are primarily a tech, which means we invest in companies that have technology as their core offering, not necessarily tech enabled, but we do want tech as their core offering. Certain sectors that we are very clear about. We invest in climate tech and sustainability startups. So companies that are circular economy or working with carbon credits or helping, recycle, upcycle battery technology, all of this. Secondly, we invest in software and AI companies. It's unfortunate that everything software today has come under the umbrella term of AI.
Yeah.
When we started the fund, we called ourselves, a SaaS fund, but today it's an AI fund as well.
And how big is the fund, Vinit?
In US dollars, it's a $30 million fund. In Indian rupees, it's about 250 crores total fund corpus. And we write early checks of anywhere from $500,000 to $1 million, which is, say, about 5 to 10 crores.
So now, if you're writing $500,000 to $1 million checks, what do you want to see in the company before you're willing to write those checks?
Great question, Shravana. Because I have myself been one of those early founders, I think we have a lot more empathy for the founder's journey and where they are building from. What we expect is, given how easy access to building technology has become with all of the coding tools available, the least expectation is that the product should be ready, right? The first version of the product, the MVP, should be ready. We do not demand that the company should already be making revenues, but we do want to see and ask the founders how they will make money. We want that clarity of thought. They may not be making money, but they need to be able to explain how they expect to make money.
And how much customer engagement do you want to see before, to support those claims?
Sure. Now, customer engagement would have meant revenue. We are okay pre-revenue, but what we do expect, if there is a certain customer persona, we want to know that they have spoken to enough customers. Now, enough is a wide number. If you're doing a B2B enterprise product, even talking to 10 companies is a lot.
Yeah.
But if you're making a product that is a little bit more small and medium business or consumer, then, even talking to 50 is sufficient.
Okay. So customer conversations and insight is fine. You don't necessarily need paying customers to write your checks.
That is correct.
Okay. Now, let's do a few case studies of what you have invested in. And as you're describing those stories, tell us a bit about how you found these companies or how they found you, and what did you see in those companies that made you want to write those checks?
Sure. Now, I've had a much longer career as a VC, not just at Takshil. Before this, I was head of investments at another fund for 6 years. So Takshil is also me coming back to being an entrepreneur and starting something. So I will tell you the full range of investments because Takshil is a new fund.
Mm-hmm.
At Takshil itself, we have made our first investment, which is a company that generates lab-grown diamond jewelry. They have a chain of retail stores. But unlike an average retailer, they are incredibly tech-enabled. They have very few pieces in the store, and a huge chunk of their catalog is this AI-generated catalog, where users, once they select one or two pieces that they want to see, the catalog automatically shows them dozens of other pieces that, aren't necessarily in the store, but they now are available to them virtually to try on. This is the most recent company we have done. Prior to this, the company that I invested in was helping farmers generate carbon credits by adopting, green agricultural practices. Now, farmers in India, on average, do use fewer chemicals than farmers in other developed countries. However, they do, over the years, they have picked up some bad habits. I call them bad habits in terms of using, synthetic pesticides and fertilizers. So what this company does is it trains those farmers on how to go back to more traditional green agricultural practices, and then certifies that the farmers are using this, and that allows the farmer to generate carbon credits, which then can be sold in the open market for carbon credits. The farmers keep 80% of the value of any credits, and the company makes 20%. So it's a win-win where they don't charge the farmer anything for training them, and they only make money if the carbon credits are sold.
And so that's one side of the carbon credit marketplace where the farmers are furnishing the credits. How does the company find the buyers? It operates as an exchange.
I believe Sure. Today, there are quite a few marketplaces for carbon credits.
Oh, so it is not a marketplace. It is selling into those other marketplaces, yeah?
Right. So these marketplaces exist, and the company will go list on those marketplaces and make these credits available for purchase.
Got it.
What I meant to say is the marketplaces for these carbon credits are fairly, well established. So you have a choice of marketplaces where you can list.
Yeah. Okay. And so the investment thesis you started to describe, and maybe we didn't finish that discussion, the diamond company doesn't fit in that framework that you described.
So I agree with you. So we do have a wide-ranging thesis. Like I said, we are interested in companies that are tech-enabled. We have made other investments in tech-enabled companies. one of the things that we have also realized is we are not a vertical fund only for climate tech or only for SaaS. If you are a fund in India, you have to be a little generalized. And the reason for that is, I think the number one factor that helps us make a decision if we want to invest in a startup or not is the quality of the team. Now, sometimes you may find an incredible team that isn't necessarily doing, making a company in the specific sector, and you just want to back the team. So this is incredibly valuable and very important to us.
So sorry, please finish.
Yeah. So when I say incredible team, one thing that, a lot of founders feel is, investors are only looking for people who come from the top colleges and have a great, pedigree in terms of academic qualifications. That is actually one thing not believe in. I myself do not come from the IITs or the Ivy League. So it's much easier for me to recognize founders independent of the tag of their educational institution. What is most important is having an incredible insight about your target customer.
Yeah.
Right? And that allows us to identify the right kind of teams.
So, I completely resonate with you in that 1 Million by 1 Million's philosophy is democratizing entrepreneurship education, incubation, acceleration, and we have been completely open to all kinds of entrepreneurs. And as a result, we have both seen and enabled entrepreneurs from all kinds of different backgrounds. And yes, some of these high-flying backgrounds generate very good entrepreneurs, and part of it is they generate very good entrepreneurs, and those, because of those networks and ecosystems, they get access to more resources very quickly. They have the right networks and they get plugged into the networks easily, and so on and so forth. But the hunger level of people who don't necessarily have those backgrounds is high, and they're willing to do more, stuff that other people may not be willing to do, and we have tried to enable them very extensively. So I'm happy to hear that you have that philosophy and that point of view. Now, talk a little bit about these two specific investments that you have described a bit. What was the situation when they came to you? What did they have? What did you see that made you want to work with them?
Great questions, Raman. And I only picked these two investments because these were most recent. There have been others, but to talk about these specifically, how did we discover them is great. Both of these startup teams actually were inbound to us, meaning they reached out to us either on LinkedIn or they were referred to us by, maybe someone else we knew, another founder we knew, right? The majority of founders do reach out to me on LinkedIn.
Mm-hmm.
I post very frequently on LinkedIn. I usually share stories about my own days as a founder,
mm-hmm.
right? Which resonates well with other younger founders, because I have been there. I have spent more than 16 years, being a founder of my own startup. Now, what resonated with me about both these companies, right? Now, like you correctly pointed out, what is the use of a diamond, lab-grown diamond retailer? How is that a tech-enabled business? Two things that helped us get past the hurdle of, looking at a company like this. Number one, what we realized is that the founders actually did not come from a jewelry background.
Mm-hmm.
So they were looking at this industry from a very first principles, problem and solution perspective. And what I mean by first principles is they stepped back in this case and they asked, hey, listen, what is it going to take for diamond jewelry to be more widely purchased by the average Indian, by the common man?
Mm-hmm.
Now, diamonds are fairly expensive and not everyone can afford diamonds. But with lab-grown diamonds, affordability had become less of an issue
Yep.
and the bar for, a purchase price had lowered. However, they still realize that the retail experience still makes it very expensive because you have to keep so much inventory, you have to have large stores, and all of this. What they were able to do is using technology, able to ensure that per store, the inventory is very low, which means their operating cost and their capex is very low. And hence they could maintain the price point at a low point versus also keeping the quality of samples very high. So being
The
fully
model
tech
is
enabled here was a value.
the model is stores still. They're creating stores and the experience is
So
stores,
Samana, that's a
retail
good
stores.
question. There is a percentage that is stores, but at this point they are, I believe, don't quote me on this, about 40% of their sales are purely online.
Online, okay. All right. So this is interesting. I have tracked a company that was a pioneering company in selling diamonds online. That was Blue Nile. You must be familiar with them. That entrepreneur actually came from the diamond industry. I think his family had roots in the diamond business, and he had a core insight, which is that at least in the United States, diamonds are purchased not by women but by men as engagement rings that they offer to their fiancés. So, and the purchase cycle is not so much the glamour of Tiffany's and all of that, but it's more value based. It's what is the price of a diamond based on cut, on clarity, etc., etc. So he kind of created this retail experience that was an information experience, basically, kind of a geeky purchaser, buyer, learning about diamonds before making a large luxury item purchase. So, and that was a completely contrarian thesis. Nobody believed that diamonds could be sold online. And actually, a very close friend of mine invested in the company early on, and it worked. Now, this was 1999. Of course, e-commerce at the time was very immature. And now your company is coming into this business much later with a very different level of awareness. And here, I think the thing that, those of you who are listening would find interesting is in the positioning of the venture, in the sense that who is buying? Who is the likely buyer of a lab-grown diamond? If affordability is the primary value proposition, it must be people who care about affordability significantly. And what is that thesis that you discovered in this process? And of course, now the business is working and you are validating that thesis. So what are they learning?
Sure, Samana. I think that's a great question. You are absolutely right that there has to be an entirely new buyer persona attached to a new business, right? In the case of, and just to complete the arc on the American example with Blue Nile, while we were analyzing this startup, we asked, what is the world looking like? And we realized last year, for the first time, more than 50% of the engagement rings purchased in the US were actually lab-grown diamonds.
All right.
It was a very shocking statistic. Now, the percentage could be off by a few, but the fact that we are even talking 50% was a shock to us. And at least in this, America is a leading indicator that, if it has happened there, then other countries will follow suit. However, what is a very unique Indian insight over here is India has not been a mass market for diamonds just because of the price of a diamond, right? It's much higher than what the average Indian earns.
And the culture values gold.
Of course, because gold is not just jewelry, it is also an incredible store of value for families.
Yeah.
Right? Gold is savings. Unfortunately, fortunately, I don't want to comment. Diamonds are not savings. Diamonds are more of, buying something because, you like it, as opposed to buying something that you pass on from generation to generation. However, what has changed is an incredible aspiration in the Indian middle class to want to buy diamonds more often. In fact, one of the things we discovered is a very high percentage of buyers from this startup are usually buying the first diamond in their family's history.
Mm-hmm.
Right now, this is very important as an aspiration, because a lot of times customers come in and when they make the purchase, they basically say, oh, I wish I could have gotten a diamond for my wedding, but I'm glad I am now able to buy a diamond for my child's wedding.
This is very interesting because this is a business that is targeting a less affluent customer base than the, typical luxury product buyer in India. And it's kind of going into segments that have not been the most popular segments for the Indian tech companies, e-commerce companies. And I like that because, those markets need to be opened up with interesting value propositions, and they have some amount of purchasing power, but the economics are different. These are they're lower margin businesses, right?
Well, surprisingly high margin business, this one. I would not want to disclose their financials publicly, but surprisingly high margin business. Also, this ties in with what I said about finding incredible founders, right? These founders had this thesis, they had this insight, they went out, they tested it, and that is what they learned. And, before they went out and tested this hypothesis, most people, including myself, would have not assumed that this market exists today. I may have
No, the
assumed this
diamond
market
market,
exists
the
5 years
diamond
later.
market exists because we did the Carrot Lane story a long time ago. Carrot Lane was doing the Blue Nile story in India a long time ago. We did Carrot Lane's case
Sure.
study very early on, Mithun Sacheti. But I think lab grown is a different positioning than the luxury diamond positioning. So they came
Absolutely.
to you with a validated thesis. They were already selling by the time you met them.
In this case, they had set up a demo store of their own to validate the thesis, which was great. It was not a prerequisite to the fund's thesis, but I'm not going to say no if someone already has gotten a little further along in their journey.
And where was that first store?
It was in the founder's hometown of Calcutta.
Oh, interesting. What is the name of the company?
It's called Jewel Box, Jewelbox, Jewel Box.
Very good. Well, if they have reached 5 million in revenue, I would love to do the story. We do these entrepreneur journey stories and very high profile, very detailed case study based stories. We'd be very, very interested in doing the story.
I'm very happy to separately offline connect you with the founders. Incredible founders, brother-sister duo. I think incredibly smart, incredibly humble. And in my experience, that's the killer combo, right? Very
Fantastic.
insightful and yet very humble.
Very good. So the other one, the carbon credit trading, or
we've had a couple, Smrana, on the carbon credit. It's a personal favorite area for me.
Okay.
So the one I talked about with the farmers, and there's another one in carbon credits.
So before you go to the other one, first tell me about what was the situation that you discovered these carbon credit entrepreneurs in, the one that you did talk about already. What were they doing? How much validation did they have? What before you wrote the check?
Sure. In this case, they did not have any revenue when we started speaking with them. They had some early conversations. They had some early contracts that they were in the process of signing.
Yeah.
But the scale that they wanted to achieve, that is why they wanted to raise the funding, because, this required a lot of upfront investment into training the farmers, ensuring the farmers were buying more green, pesticides and fertilizers. Now you and I know, unfortunately, they cost more, right? So convincing farmers to buy something that costs more for an unsupported thesis is always an uphill task, right? Because the farmer would see the value of it at the end of the production cycle when the carbon credit would get generated, and then they would make more money. So there was a lot of upfront hesitation.
And what, the venture equation, which a lot of entrepreneurs struggle with to grasp, is you have to go from 0 to $100 million in 5 to 7 years once you've entered the venture timeline. If you're not doing that, then it's hard to make the fund equations work. There are some small funds that are doing bootstrapping to exit or seed strapping to exit kind of deals, and that's a slightly different investment thesis, but still need to find high velocity companies to be able to exit them. Without velocity, exits don't really happen. So how did you reconcile the velocity equation in this story that you're talking about? I mean, I can imagine Indian farmers training them. It's not a fast process. It's not a high velocity process.
I agree with you, Samrana. And the reason we were okay with this kind of a velocity initially is what we very quickly realized is, while it is not easy to train a farmer just because of the time it takes to grow a crop, right? You cannot train a farmer today and next week expect them to have finished, harvesting the crop. It has its own seasonal cycle. What we quickly realized is a lot of the farmers were waiting on the sidelines to see the first success.
Yeah.
So the word of mouth in the farming community is actually incredibly high value, right? While there is a lot of upfront effort to get those first early adopters, but once you have gotten a set of early adopters with whom you've been successful, your go-to market, so to say, right? The virality of this is actually incredible, right? It's an untapped virality because farmers are always talking to each other. Our farmers in India are fairly tech savvy. They may not be using the latest apps or products, but they're all on WhatsApp. They're all, searching on Google. This is something that, I learned from another agri-tech investment we had made few years ago. It was an app for farmers to learn from other farmers. And that had already given us an insight. Some of us like me, who sit in big cities, we think that we are tech savvy, but I've got to tell you, when it comes to using the right apps and products to help grow, and, produce better, Indian farmers catch on very, very quickly.
And language is not a barrier?
Well, language is a barrier, but there is enough content now available in their language.
So when they came to you, did they already have some of the early adopters on board, or did you take that leap of faith as well?
No, like I said, we like to see some insights that have come from customers, which means you need to have some early adopters, at least with whom you can have a conversation, right? So one of the things that we do as a fund is, as an investor, we will pick up the phone and talk to the so-called customers that the startup is saying, hey, we have some, people we have spoken to, right? We will also do some random calling to get first-hand information, just so we can make up our mind on what we are hearing and reconcile it with, what our own thinking has been.
And this particular company, where are they based? Where in India are they based?
This company is based in NCR, in New Delhi.
Okay. All right. You wanted to discuss another, I'm going to go to the pitch portion of the conversation, but I would like to give you an opportunity to discuss another one that you started to discuss.
Sure. This is also in the carbon credit space. but this is not targeting farmers. In an incredible founder, the name of the company is Sustanium. And this is the founder you should bring on to your calls for sure. Her name is Sapna. This company built out an incredible product to not just help people trade carbon credits, but to certify carbon credits. Now, what's shocking is this young company, when we originally met them, they were based in Bangalore. Now they've moved to New Delhi. They became one of the signatories to the Kyoto Protocol, and they are one of only maybe companies globally that can certify carbon credits.
Wow.
The way I think of this business model is, imagine having a license from the government to print money for the government, right?
And now, why is that? So how is it that it is one of two companies to certify carbon credits?
This is a trait we have consistently seen in some of the smartest founders, right? They don't just wake up one day and have an idea and go ahead and execute it. They have actually spent many, many years building up their competency, building up their networks, building up their knowledge about the industry. So in Sapna's case, she was already working as a consultant to one of the state governments to help build their entire, environmental policy for the ministry, right? So, and this is a person who had worked at the global level, to help be a part of policy framing conversations. So when an opportunity came, right, now a lot of these opportunities, when they start off, they are very small opportunities known by a handful of people who are deep in the industry. So in this case, the founder could capitalize on being
A domain
at
expert.
the very early days. Yeah, exactly. Right.
And
today it sounds shocking. Sorry, Smriti, I'll just complete. Today it sounds shocking that how did this person get access? But when they got access, it wasn't a big deal. It became a big deal much later.
I see. And the other set, the ones that are selling carbon credits to or on behalf of farmers, is that somebody from the carbon credit industry or from the agriculture industry? Where do those founders come from?
That's a great question. They are not from, they have not been farmers themselves. That is not something that they come from as a background themselves. However, what is very interesting is they had an insight about carbon credits and they realized that there isn't enough opportunity for the farmers to be able to build a product that would, allow them generation of carbon credits. Like a lot of farmers don't even know that, this is free money. And what's very valuable is, if you compare the income of an average farmer in India, even if they can add on a few carbon credits every season, right, as a percentage of their net take home, it's a very high number.
I see. So they understood that equation somehow.
They understood that equation, and what they also realized is there needs to be initial, sort of concept selling to the founder. They need to sell the concept that, hey, listen, spend a little bit more, and then in the end of the season, you will make more money.
Interesting. I'm sure you hear this in the AI conversations in particular. This conversation today has not been as AI heavy as we normally have. But in the AI conversations, there is a lot of discussion of domain knowledge, because the people who are really able to extract value out of enterprise AI, for instance, and workflow and so forth, are people who have deep domain knowledge and have those insights of what exactly is happening and where can they add value and working through those processes. When I've had a few conversations that are actually relevant to what you are describing is, in the first wave of the internet, the .com bubble, so to speak, I was a 3x entrepreneur in that 90s period. And we were all very young. You know, I was only 24 years old when I did my first company. I was still a grad student at MIT and so on. And we were kind of doing whatever, right? That era was not about domain knowledge. It was about whoever had the courage and the curiosity to figure something out, because nobody really knew anything. Nobody understood the internet. It was, you know, we were just kind of shooting from the hip and learning as we were going. And as a result, careers accelerated tremendously and so on and so forth. And, you know, companies got built, companies got killed, all of that's happened. Now, what you were talking about, some of these ideas, and you're underscoring the fact that they do not come from people with domain knowledge. And the diamond one is a B2C business. The carbon credit for farmers is kind of virgin territory. It's not a domain where, you know, farmers is not where technologists are hanging out. So there's no way of having domain knowledge of farming really for technologists. And the certification one, it does come from somebody with domain knowledge. That's a rather unique one. But I think there is probably a reasonable point to make here, is that if you are a very young entrepreneur, you don't have much background, much experience in a domain, you would probably find ideas to work on that are more in either B2C or in B2B, but that are much more esoteric B2B, where a lot of technologies are not really circulating. That's kind of some nuggets that I pick up from this conversation. Do you agree, Vinit?
Smrana, you are correct. There are certain instances where founders have deep knowledge. For example, you know, the carbon credits one example, and certain examples that founders did not have domain knowledge. What we have learned is, even when there is no domain knowledge, the founders have actually invested a significant amount of time talking to their customers, talking to the vendors, talking to the supply chain. And I think a lot of founders miss out on that very important point, that it's not about talking. It is about talking and then discovering insights from those conversations. And that was the kind of founder I was as well. Right. My last startup was in construction material. I have no educational or academic or professional experience in that domain.
Yeah. So I did one in, first and foremost, I was very young. So everything I was doing was based on just kind of whatever I was figuring out. But I did one that was so far outside of anything Silicon Valley was doing. It was on fashion. We did the first fashion online company in 1999, and it was designer fashion. So I was a consumer of designer fashion, but I was not I didn't have any business knowledge. So what I did, the first thing I did was I hired as one of the very early team members, a VP of merchandising out of Bergdorf Goodman in New York, who was in charge of women's merchandising. So I kind of learned the fashion business from him. He taught me the fashion business. I understood the technology part, and I was doing, at that point, we were doing personalization very early on. But it was an enormous amount of learning and really immersion in the designers, and I was spending half the month in designer offices in New York and really learning the business and helping figuring out what they could do with our world, which is the technology world and the internet. So anyway, to be continued, Vinit. Let's switch to Adesh and Abdul's presentation. You're welcome to stay. Would you like to stay?
I will hang out for a bit. I had kept some more time, and I may then drop off at some point.
Perfect.
Thank you.
So folks,
thank you so much, Smrana. I appreciate this conversation.
Most welcome.